They say you can't teach an old dog new tricks. But what if that 40-year-old networking giant is trying to learn the very complex language of artificial intelligence? The market seems to think Cisco Systems is already fluent, pricing it like some kind of growth startup. But, well, the fundamentals might be speaking with a very different accent. Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today we're conducting a deep dive into Cisco Systems, that's ticker CSCO. Our research is based on data from today, November 12th, 2025. The stock's currently hovering around, $71.71. So our mission is to figure out, is this AI-fueled rally actually grounded in reality, or is the market just, running purely on hope?
Well, starting with the broader picture is probably key here. The context matters.
Okay.
Pre-market, the NASDAQ, the tech-heavy index, it's pointing upwards, signaling a bit of a risk-on mood.
Right.
But if you look a bit deeper, that confidence feels, fragile. We've still got this lingering uncertainty from the government shutdown, possibly messing with unemployment data, and that makes the Fed pretty hesitant about any kind of December rate cut. So uncertainty is really the name of the game. And that makes buying into a hardware giant like Cisco, where growth really hinges on stable corporate spending, it makes it especially risky right now.
Okay, that makes sense. So let's unpack the narrative then, the story that's pushing this stock up. Cisco's making what some are calling a textbook pivot to AI. The story is compelling.
It is.
We're seeing the launch of their AI-powered Cisco IQ platform, and maybe more significantly, that switch they co-developed with NVIDIA, right? High performance.
Exactly. That NVIDIA partnership is a big part of the bull case.
And this is directly feeding into market expectations for today's Q1 earnings. Analysts are looking for, almost an 8% jump in EPS?
That's right, an 8% jump in earnings per share, and they're saying it's explicitly driven by AI demand.
Wow.
Okay. But let's pivot now to the cold, hard math, because while that story sounds great...
Always the numbers.
The fundamental numbers tell a, let's say, more cautionary tale. Our fair value analysis, using discounted cash flows, it suggests Cisco's intrinsic worth is actually only somewhere between $47 and $61 per share.
47 to 61. Compared to 71 today, that's a huge gap.
It is. The market's essentially treating Cisco like it needs to grow into this valuation, like a startup. But the current financial engine, it's just kind of chugging along at a modest 3.2% revenue growth. Not exactly startup speed.
Wait a second. If they've got this big NVIDIA partnership for switches, targeting GPU clusters specifically, why isn't that current growth number higher already?
That's a great question.
Is the AI revenue just stuck in backlog, or are investors basically just pricing in sales that haven't even happened yet?
It seems to be largely the latter. The market is pricing in the speculation of future AI revenue, not really the current delivery.
Okay.
Now, this brings up something interesting. If the fundamentals are, shall we say, underwhelming relative to the price, who's actually buying the stock up here at $71?
Good point. Who is?
Well, the crowd is overwhelmingly bullish. If you look at the options market, the put-to-call ratio is incredibly low, 0.4.
0.4. That's extremely bullish.
Extremely. It signals a near-universal vote of confidence. And short sellers, they're definitely staying away. Short interest is tiny, just 1.22% of the float.
That is fascinating. But doesn't a put-to-call ratio that low, like 0.4, sometimes mean everyone who wants to be bullish is already in?
It can be, yeah.
That kind of extreme consensus can sometimes be a contrarian signal, maybe setting up for a pullback.
It's definitely a risk factor to consider.
Okay, technically speaking, the long-term trend looks undeniably strong. The stock's trading comfortably, way up there above both its 50-day and 200-day moving averages. Cruising altitude.
The long view is positive on the
However, when you zoom in, look closer at the immediate term. Several short-term momentum indicators, they've actually flipped bearish. The stock seems to be consolidating, kind of losing steam right before tonight's earnings report. Signs of fatigue, maybe?
Exactly. So putting all these pieces together, you've got the strong narrative and the nice long-term trend.
Right.
But you also have this weak valuation picture and, frankly, tired short-term momentum. It leads us to a neutral stance, but with a bearish bias.
Neutral, leaning bearish. Okay.
The main risk, the thing that could blow this cautious outlook out of the water, is if Cisco delivers a genuine blowout earnings report tonight. One so powerful it somehow manages to justify that pretty lofty valuation premium the market's giving it.
Got it. So for you, the listener, here are the concrete battleground levels to watch today as this plays out. On the upside, the bulls really need to reclaim momentum. They need a break above $74.50. That would signal this consolidation phase might be ending.
The key level, that's $74.50.
And to the downside, the key defense line seems to be sitting firmly at $69.
$69.
Yeah, and that level looks pretty well reinforced, both by options market activity and the 50-day moving average coming up underneath it.
So you could say Cisco has successfully gotten itself onto the AI dance floor. It's secured a dance with the biggest names like NVIDIA. But this raises, I think, the most important question for investors right now. Is Cisco's actual performance on that dance floor going to be good enough to justify the current very steep price of admission?
A great question to end on. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.